Dividends are payments a company makes to share profits with its shareholders. They are paid on a regular basis, and they are one of the ways to earn a return by investing in stocks. However, not all stocks pay dividends. Dividend-paying stocks can provide a consistent and growing income stream. Investors typically prefer to invest in companies that pay increasing dividends year after year, which helps them outpace inflation. Dividends are more likely to be paid by well-established businesses that no longer need to reinvest as much money back into their operations. High-growth companies such as technology or biotech rarely pay dividends because they must reinvest profits in order to continue growing. But there are also companies that offer high dividends to attract potential investors. And so, today I'm going to show you some of those companies. The first one is Target. Despite the challenge of competing on price with discount retail giants like Walmart, Target has consistently proved it can win without it. The company has been more profitable than its competitors for years, with some of the highest gross and operating margins. Despite its focus on expanding its e-commerce business and offering new products in stores, Target's sales and profits have grown at a solid clip. With its 49th consecutive year of dividend growth, dividend investors should take note. Next, realty income. In order to invest in attractive real estate for income and growth, this may be the best stock for you. The company has a wide portfolio of largely e-commerce resistant properties with strong cash flows generated by long-term leases. Realty Income is one of the index's newest members, having joined in January 2020 following 25 years of dividend increases. Next, Johnson & Johnson. Johnson & Johnson has a slew of great brands that make products that people need, particularly in the healthcare industry. After even bringing a vaccine, Johnson & Johnson has vast, consistently successful pharmaceutical and medical device activities, which have allowed the corporation to raise its dividend for 60 consecutive years. This unrivaled variety of consumer health brands, pharmaceuticals, and medical devices has proven to be a huge profit generator. The next one is Lowe's. The home improvement behemoth may not appear to be a particularly intriguing stock, that is, unless you enjoy dividend growth. The corporation has grown its dividend for 46 years in a row and has increased the distribution by 470% in the last decade alone. Another key figure in Lowe's favor, the typical home in the United States is 37 years old. Lowe's will see a lot of money from the next generation of DIYers. The next big brand is Microsoft. Microsoft has consistently raised its revenues as one of the world's top firms, and its emphasis on recurring or subscription-based revenue sources is particularly appealing to dividend investors. The company has a strong financial sheet, with more cash than debt and a low payout ratio, allowing it to raise the dividend significantly. The next big company is American Express. Another good place to look for dividend stocks is in financial services, and American Express is one of the best in this category. For decades, Amex has either increased or maintained its dividend regardless of the economic climate. Consequently, it is both a safe investment for long-term investors and a reliable source of dividends in weak economic times, because of its high-quality lending standards and its focus on higher-income consumers. And the last one, Clearway Energy. It's common to think of renewable energy as a growth investment, but its dividend potential is also fantastic. Clearway Energy, owner and operator of utility-scale wind and solar assets, is a perfect example for this. Clearway Energy acquires, operates, and sells the power on very long-term contracts to utility companies. For those searching for a less volatile and safer renewable energy investment, Clearway Energy is an excellent choice. So, that's it for today. If you enjoyed, share this video and leave a comment.